All right, so good morning, everyone. Welcome to today's macro snapshot. We are Thursday, April the 17th, 2025. Recording this, as always, in the morning. Um, okay, so let's look and see a little bit what's going on overnight. A couple of interesting things today. We do have the ECB meeting. First of all, yesterday we had Powell speaking. And talking of Powell, I just saw a tweet just to begin this beautiful day from Donald Trump saying that something to the effect that, Powell can't be fired soon enough. Let's get rid of him. And he and Trump was talking, basically saying that the ECB is expected to cut interest rates today, which is true, and saying that Powell should be cutting interest rates as well. So Trump not at all happy with what Powell had to say yesterday, and just talking about what Powell said yesterday, he was actually pretty hawkish, in my opinion, and in a sense. Essentially, he was saying that the two mandates might start to come in tension, and the one mandate being full employment, and the other mandate, of course, being price stability and keeping inflation under control. And essentially, Powell yesterday was relatively, I would say, pessimistic and downbeat about the future prognosis for the US economy, essentially indicating that he thought that there would be a rise in unemployment, that inflation would remain relatively sticky, and that the economy would slow. So a kind of a stagflationary sort of overview, which was not taken well by the market. We actually saw, a relatively aggressive sell-off yesterday afternoon after he spoke at about 1:30 in the US stock market. So fairly downbeat. But what Powell did say yesterday as well, and I think this is what irked sort of President Trump, was the fact that Powell said that if the two mandates of full employment and maintaining price stability, if they were to come into tension, and that's what Powell is expecting, he gave the impression that his first priority would be to keep inflation under control, and that he's very keen to avoid having long-term inflation expectations rise. So essentially, he was sort of saying, well, if push came to shove, we would be prepared. We at the Fed would be more prepared to accept a slightly higher unemployment rate and an economic slowdown, rather than sort of cutting too prematurely and letting inflation rise. And of course, Powell, of course, Trump is upset about that. So that's where we are with the central banks. Talking about central banks, let's have a little look at the ECB here. So we can see here that the ECB, which is meeting pretty soon within the next hour or so, fully priced in today, the 17th of April, as you can see here, one cut, 99% priced in, so 24.7 basis points. So a full cut priced in. Really, what's going to get the market's attention is really going to be the commentary going forward. We had yesterday the Bank of Canada, very sort of honest and transparent, essentially saying that they didn't know. They're trying to model different scenarios, 10% tariffs, 25% tariffs, a reduction in tariffs, increase in tariffs. And they essentially said that the risks, this is the Bank of Canada, the risks are tilted towards the downside for a slowdown in the Canadian economy, but it would be very much tariff dependent. I'm expecting a relatively similar kind of tone today from Lagarde. In the sense that they're going to be firmly data dependent. She will probably say that risks remain balanced, that they are on no, what does she like to say, no predetermined course for rate cuts. But I think what the market will be most interested in is, and we can keep an eye on, let's say, this June pricing here. You can see in June, there's about 1.7 cuts. So let's say that's if they cut today, there's almost like a two-thirds chance of them cutting in June. The market really, and we can see this just on a tick chart here. I'll be looking at this. So far, we've got 42 basis points cumulatively priced in. So you have to discount the 25. So that's about, what's that, 17 out of 25. So the thing is, what we want to be seeing from Lagarde today is really if she, just what she says about inflation. Does she believe that inflation is coming down towards target? And what is interesting is that over in Europe, we've seen natural gas, the price for nat gas come down. We've seen the price for oil come down globally. Brent crude is down quite a lot. So the point is that the energy, which had been one of the main causes of that spike in inflation back in after Russia invaded Ukraine, energy prices in Europe have come down, quite substantially in the last month or two, and therefore that could give Lagarde a sort of an excuse or a justification or cover to say that inflation was well on target, going down towards the 2%. So the point is that as the energy prices are going down, Lagarde could say, look, energy prices going down, inflation's going down, and therefore that would allow her maybe to open up a bit more dovishness in the communication. So we want to see what she has to say about inflation. Secondly, in terms of the tariffs, and really the outlook for the European economy. What the market wants to know is whether Lagarde sees the tariffs as representing a high probability of slowing the Eurozone economy, or really just like maybe a 0.5% hit to GDP or so. And of course, the third thing, apart from her views on inflation and the future path of the economy, is the future path of interest rates, and whether she hints that, maybe if they cut 25 basis points today, that's really enough, and they're going to really sit back and wait and see, or whether she gives the market to understand that, the slightest hint of the economy slowing or unemployment worsening, they will cut. I mean, just how preemptive are they prepared to be? And that's going to be reflected here in the overnight interest rate swaps here for the Euribor, the Eurozone here. So let's see if that goes up or down. Now, in terms of the euro, what's interesting is that a lot of people have been talking about the sort of interest rate differentials, and it's true that the interest rate differentials between Europe and the US, or let's say Germany and the US. So let's just actually bring those up pretty quickly here, if I could find them. So let's say here US 10-year minus Germany 10-year, and you can see here that the US is far outstripping. So, the interest rate differential is widening, or almost up to 1.9%. And according to sort of, econometric models I've been reading about, an analyst report and whatnot, a lot of most economists and analysts say that because of this interest rate differential, in a classical kind of correlation, the US dollar should actually be a lot stronger by 1.5 or 2% against the euro because of this interest rate differential. But as we all know, that's not the case. And if we actually look at the euro chart here, which we will bring up in a second, you can see here that the euro, essentially for the last couple of months has been outperforming the US dollar. It's been going up against the US dollar, and could have pushed up towards the 115. It looks like that's where it wants to be at, and that is against the sort of normal correlation. So the correlations have broken down. So the euro at this point is really trading on sort of weakness in the US dollar, and the weakness in the US dollar is really the fear that the US economy will sort of slow down, but also there's kind of a risk premium. There's a lot of uncertainty. So there's quite a lot of sort of a certainty premium, or sort of safe haven premium, probably 1 or 2% being put into the euro at the moment. And the euro is also sort of benefiting from this sort of outperformance, or perceived outperformance, of the Eurozone economy versus the US economy. So that's probably how the euro is going to sort of trade today, not so much based on the interest rate levels, but really based on whether Lagarde says that she's prepared to kind of stimulate and to help, quote unquote, the European economy. That would be a positive for the euro here, even if they cut. That's my point. I'm saying even if they cut the euro, the interest rates, that's fully priced in. And even if she's slightly dovish about cuts, I think in terms of the euro, that might be perceived as a positive for the Eurozone economy, which would therefore be perceived as a positive for the euro. So the euro, I think, on balance, looking, fairly supported at this point. But let's see what Lagarde has to say. In terms of overnight stuff, just while we're talking about some currencies here, we had the beginning of some trade talks in Washington, I believe it was yesterday, between a Japanese delegation and the Americans. Excuse me, just grabbing some Lady Grey. And essentially, Trump, as is his style, came out and said tremendous progress being made, et cetera, et cetera. But the head of the delegation, a certain Mr. Akazawa, was a little bit more circumspect, and basically said that, the talks between the Japanese and the Americans on the tariffs were constructive, but they agreed to talk within a month. But it would be complicated going ahead. And so I think the point is that Trump wanted to push this like, oh, amazing progress. But the Japanese were probably a little more sort of realistic and, as I say, circumspect, and essentially saying, well, okay, we've started to speak, but this is a complex deal. And this is not going to be resolved anytime soon, in the next week or 2 or 3 or 4, maybe in another month or two, but there's a lot of complexity. So the thing is, just in terms of the Japanese yen, we did see, this is US dollar, Japanese yen on the daily, we did see that the Japanese, the US dollar made a little bit of progress against the Japanese yen. But as you guys can see already, that's sort of come back a little bit. So essentially, sort of unchanged, really, not a huge amount going on there. And that's a similar kind of situation. If, a lot of people saying, a bit of positivity. So, were the trade talks with Japan net a little positive? I guess you could argue that. We also had overnight some earnings from TSMC, the big, huge Taiwanese semiconductors, which were pretty positive. So, you say, well, okay, that's going to give a little bounce to the stocks. And we did get a little bit of a bounce to this is the ES futures. And you see they bounce, but as you can already see, giving back a little bit of that and still well inside yesterday's very negative sort of red candle there. Similar kind of situation on the NASDAQ, had a bounce, but, not really following through. And maybe that's just because, at the end of the day, we still have a lot of uncertainty with the tariffs. There's no, there's ongoing talks, the Chinese looking for respect, China, Trump maybe not going to give them that respect and open talk. So the point is that at the minimum, we can say we're in uncertain times. The other thing is that we saw this morning DR Horton. What's the ticker for that? Is it DH? Uh, yeah, DR Horton, which is the huge homemakers, home builders in the US. I just had a quick look at the numbers. They look to be a little bit negative, and you can see here in the pre-market, they're down, well, not a huge amount, but down about $4 or so. And it's just interesting if DR Hortons, which is one of the largest sort of upscale home builders, as I said, in the US, if their sort of forward guidance is a little bit negative and pessimistic, maybe that's just going to calm down the market a little bit and say, hey, things actually are slowing down a little bit. So interesting to see how that trades today and other earnings we're getting. In terms of other markets, we're seeing just on a little bit of risk on in the US. We're seeing some of the bonds pull back a little bit. We saw LVMH yesterday, Louis Vuitton, the huge luxury goods maker, basically saying that they were doing quite well in the first couple of months of the year. They started the year well, but then after the tariff uncertainty, their sales went down. So they had sort of pessimistic forward guidance. Just in that space as well, we saw Hermès, who have been doing very, very well. The French luxury goods maker also had a sort of slightly disappointing earnings this morning. So Hermès and Louis Vuitton, Moët Hennessy, basically not doing super well. And again, I think really the overall takeaway, if we just sort of pull back, is sort of people are pulling back, spending is being put on hold. Maybe we're not collapsing, but spending and investment is being put on hold. And that uncertainty is just going to continue to weigh on stocks. Even over in the Eurozone, which, there are some good performance there, like Siemens and whatnot. But you see here, just finding it very heavy, very difficult here to sort of trade, smoothly back up to the new highs. So that's the FEX. And if we look at the German, the DAX, the same similar kind of situation. So we had a bounce, but now just sort of stalling out a little bit. That's about it, guys. We don't really have much data. We did have the retail sales yesterday, which was strong, and even some of the revisions were revised upwards. So, at the face of it, that's pretty positive news. But there was the usual caveat that a lot of that was a lot of new car sales. And the idea was that there was a lot of front running of the tariffs being imposed, after the fact. So new car sales were very strong. Durable goods sales were pretty strong. And, the market tended to say, okay, basically discounted that and said, well, that was just front running of the economy. And in fact, it could lead down the road into the next month or two's numbers of being a nasty negative surprise because people, they've gone out and spent money on the big ticket items such as cars, and they're not going to do it again. That's that. Just in terms of oil, just sort of grinding its way up here, nothing sort of massive. There continues to be rumblings out of the Trump administration about imposing sanctions on Iran. We had Bessent yesterday, the Treasury Secretary, saying that the plan was somehow to force Iran's exports down to zero, essentially. There's also talk about trying to sort of curb Venezuela's exports. So my point being that there's still a bit of geopolitical risk and also the risk of sanctions and reducing the supply side. And I think that's giving oil just a little bit of is this a bounce or is it just sort of grinding up? Or indeed, are we starting to turn this into yet another potential bear flag? I don't want to sort of be overly optimistic about that, but potentially let's keep an eye on this for the technicians out there. We can throw a couple of badly drawn well, it looks like an ascending triangle more than anything. We'll see. But I think oil, what is interesting about oil, just quickly, is that the actual oil curve is still in backwardation. So it's not really in a contango form. So the front contracts are still trading at a premium to the further out contracts, which is a positive. So maybe there's sort of physical tightness in the market, and it's just sort of the sentiment which is keeping oil from ripping quite substantially higher. I think I'll leave it there, guys. I mean, gold continues to be very, very strong. taking a bit of a pause, but every time we've seen that, it's inevitably ripped after 2 or 3 days. So gold doing pretty well. We can see silver just having a bit of a pause, and we can see copper also having a bit of a pause. So it's clearly the hierarchy there. We have the gold as a safe haven. We have a copper, which is much more sort of sensitive to sort of sentiment and tariff talk. And then you have sort of silver, which is entre les deux, between the two of them. Okay, I'm going to leave it there, guys, because I want to go and have a look at the ECB. So hopefully that was useful. And as I say, let's see how the German bonds trade and the euro, and that could give a little bit of direction for the rest of the day. Thank you. Have a great day.